Hello and welcome to this Tuesday's morning market briefing. We've got a lot to talk about, but firstly, deal making slowdown leaves private equity with record unsold assets, as well as that Joe Biden now proposes higher taxes, as well as spending and debt in his $7.3 trillion budget. We've got lots to talk about on the charts also, but lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is to do with private equity and deal making. Now, private equity groups globally are now sitting on a record 28,000 unsold companies, with more than $3 trillion worth of companies still being unsold. This comes as there's been a sharp slowdown in deal making, creating a lack of demand, of course. Now, this is most certainly not the first time that we've spoken about private equity recently with, with this topic of, there not being any liquidity within the market, or there being no way for these private equity firms to sell off their assets. This has been a kind of recurring issue really recently as a result of these higher interest rates, which we know has been hurting these private equity firms greatly. As a result of those higher interest rates, we did start to see public IPOs, IPOs just in general, basically start to decline in the number that we were seeing, and as a result, that's the usual way that we might see private equity firms start to offload their assets to allow investors to enter but also exit. So that's a key issue that was facing private equity firms. We do know though now that they have kind of developed new strategies to kind of deal with these issues, with new kind of loan strategies, enabling these private equity firms to still enable certain investors, pardon me for my cold, still allow certain investors to basically exit their investments and allow new investors to come in during this time of a lack of liquidity and a lack of IPOs. So that's been a key thing affecting private equity firms, and there's been strategies, as we've seen, be developed to deal with this. That said, we have started to see IPOs return to the private equity industry, with certain names certainly to note. I can't remember any off the top of my head in particular, but we do know the likes of Axel KKR and many of these larger private equity firms are once again re-entering the IPO space and finding their way with selling off their assets once again in the more traditional manner, because we do know that those traditional IPOs are the ways is the way that we have traditionally seen private equity firms kind of get rid of those assets. So that's kind of been a very key thing to note. There's not too much to note though before we go into this article, so we might as well just get straight into it. Now, this comes as there's been a sharp slowdown in the deal making. That's the key thing. Now, according to recent data, the private equity industry has grown greatly over the past decade, but that said, the recent increase in interest rates have been increasing financing costs. Now, that is the really key thing to note here, is that those increases in the interest rate have not only been affecting private equity firms and the private equity industry as a whole, but many other industries. But when we are talking about the private equity industry in particular, high interest rates are very important to understand and kind of know, because ultimately it is preventing them from being able to get take certain assets off their kind of balance sheets. Basically, it's making it harder for them to sell off those assets which they might usually do through the IPO route. So that's the key thing there. Now, the combined value of companies sold last year fell by 44% since 2022, reaching new lows not seen for a decade. Now, the value of companies being sold to other buyout groups also fell last year by 47%. A key issue which is now rising from these private equity firms not being able to sell their assets is that they're unable to pay out investors who want to exit, and that is the key thing which is facing private equity firms and troubling them, is when they're not able to sell off their assets, then they're not able to reward those investors that have put their money into their firm and now want to exit. So that's why it can be a serious issue for these private equity firms if they can't kind of develop a way to kind of deal with the issue. Now, as we've spoken about before, this has forced the industry to use net asset value financing, where they can secure loans against typically highly indebted portfolio companies and thus allow investors to enter as others exit. A secondaries market for private equity investors has also emerged, with investors buying and selling their stakes in private equity firms and moving assets from older to newer funds, with the amount of money raised in the secondaries market doubling last year. That said, there are now signs appearing, within the private equity space that the usual IPO private equity exit route is making a comeback. So I think that will be something that's very interesting to know if we can see that kind of develop more, and whether we do now see kind of the phasing out of those strategies that we were talking about being developed, and we just see the return of IPOs. So definitely keep your eyes on the private equity industry. It's a very interesting time nonetheless. And yeah, keep your eyes on all things private equity. Next article to talk about, though, is to do with Joe Biden, as he has now unveiled higher taxes as well as higher spending and thus higher debt. Now, Biden has now unveiled a $7.3 trillion budget plan, which would push the US into more debt, with the plan laying out a boost in spending while saving $3 trillion through higher taxes. Now, this article kind of comes at a very interesting time for us, of course, since not too long ago, maybe last week, I think I can't remember the exact date, but we were most certainly talking about how Biden was planning to kind of actually reduce the deficit through higher taxes. So we were saying maybe the spending won't change for Biden going into the new presidential election this year, but ultimately he may try and deal with the deficit and debt issue by just raising interest rates. By just increasing taxes. Sorry, not interest rates. But ultimately, that is not actually what we're seeing here. Seemingly, whilst he is raising those taxes, we're seeing the more traditional Democrat kind of move of increasing spending at the same time. Now, this issue of debt within the US, within the public sector of the US, is of course a very large issue, with not too long ago in that article where we spoke about Joe Biden's plans to do with raising taxes and spending, that kind of thing. We did note how the CBO is now predicting the US to reach all-time record high levels of debt basically in 2030, and that of course will be highly detrimental to the US and will damage the US's image basically as a financial powerhouse. So it's kind of a worrying prospect for the US in regards to their financial situation, and what we're seeing here from Biden doesn't really solve that issue. We're seeing another kind of continuation of this issue, and we've previously noted how this is kind of an issue which has never really been solved recently by any president. Whilst we did see efforts by Bush to kind of cut spending in some areas, overwhelmingly Bush did spend a lot of money, not only on his kind of foreign policy moves, in Iraq and Afghanistan, but also back home in the US, where he did implement actually a great deal of kind of welfare kind of schemes, I believe, which cost the US a great deal of money despite being a Republican. As well as that, then we had Obama. He continued that kind of era of spending, especially considering that we had the 2008 financial crisis, which cost the US a great deal of money and thus, cost the US public sector a great deal of money. So, we saw a continuation of the US debt going up then, and then followed by that we had Trump, who promised to keep spending low. That said, we did experience COVID underneath Trump, and as a result, we did see the continuation of that high spending under Trump, just because of that kind of COVID crisis. And now we're seeing, the kind of continuation of spending with Biden, especially into public sector and private sector areas, with his recent policies to do with the Green Deal, the Inflation Reduction Act, and that kind of thing. So, we really don't have a clear plan to actually cut spending, it seems, from Biden, and we might see a difference in that from the Republican Party. However, now Biden's plans are in stark contrast to Trump, who calls for the renewal of his 2017 tax cuts. Further than that, Trump hopes to limit government spending. Meanwhile, Biden hopes to raise taxes on big businesses and the wealthiest individuals in order to reduce deficits. The increases in spending Biden is calling for would include offering tax credits to families with children and help preserve funding for social programs. Should the plans of Biden be implemented, the US public debt figure would hit 102% of GDP. 102% of GDP in 2025, which is up from 97.3% at the end of 2023, with debt being expected to further rise to 106% by 2030. The official fiscal watchdog, called the Congressional Budget Office, is yet to give their assessment of the tax plans, but the CBO will not too long ago predicted government spending and debt as a result to hit a high of 116% of GDP over the next 12 years, with economists also becoming worried over the lack of bipartisan efforts to reduce deficits. So this is definitely a key issue facing the US, and something that's very important to keep your eyes on. Sorry for the cold once again. I'm very sorry for the sniffling. I'm sure it's very disgusting, but I'll do my best to kind of stop. Next article, we've covered the articles, so next thing to talk about, of course, is the charts. To begin with, of course, we are talking about the US 30, and more specifically, more generally, US equities as a whole. Now, as for the US 30, it seems like price has once again come down and interacted with this lower level of liquidity that we have noted many times before. Now, this area has once acted as a strong area of resistance. Then we did see, kind of price spike into it a few times, acting as an area of support. And then more recently, it seems like price has now come down and used this area as a kind of base for price to move to the upside from. That said, a great deal of kind of bearish resistance that we've seen form on the US 30 recently has pushed the price of the US 30 further down and once again back into this kind of liquidity zone, as we can see here, with price selling off from that area that we were talking about yesterday to that key area of liquidity that we've noted before. The question is now whether this area of liquidity will act as, a great enough support to basically prevent price from breaking lower and basically prevent price from continuing a trend down. As we can note from here, we do have like this kind of continued period of, trending to the downside. We do have, 3 points connecting to that bearish trend line. That said, the overwhelming picture for US equities at the moment is of course bullish, so it's going to be a very interesting one to watch on the US 30. Next to talk about though is the dollar, where we do have not too much happening, but price is still in a very interesting position, especially considering the fact that we're getting the US inflation rate figure today, which of course will be affecting US markets greatly, and most specifically of course it will be affecting the dollar greatly. Now, we do have this kind of Fibonacci retracement tool drawn out, but as a result of a lack of kind of movement yesterday, prices of course nowhere near any of these areas. So yesterday, starting off the week, it does seem like we did not find much momentum to either the upside or downside. That said, we have slightly moved to the upside. We've slightly trended to the upside, but ultimately I think price is just waiting for that inflation rate figure to come out before any kind of moves are made on the dollar. So that inflation rate figure that we do receive today will be highly influential in how the dollar kind of moves going into the future, and kind of expect will definitely change our expectations of where price will be by the end of the week. So that's the key kind of piece of information to look out for today. And of course, we do have these Fibonacci retracement levels to note should price kind of come up as a result of volatility, and thus react to one of these areas before the data's actually released. So keep your eyes on the dollar. Pardon me. On this day of lots of data, next to talk about though is Euro USD, where we are getting quite a bit of data. To begin with, we have seen. Oh, pardon me. What am I saying? We're not getting too much data, of course, from the Euro USD, but a lot of data will be, of course, affecting the Euro today. Firstly, we're getting, German inflation rate figure and then the US inflation rate figure. So, the largest economy of the Eurozone, and the inflation rate figure from that nation, of course, will greatly affect the Euro. And then, of course, we're getting the dollar, affecting data from the US. So, a great deal of data will be affecting the Euro today. So lots of volatility will likely be seen on the Euro USD. So definitely keep your eyes on these levels such as down here, as well as, the liquidity level that price is currently sitting at. Keep your eyes on all these levels. Very interesting position for Euro USD to note. Next to talk about though is pound yen, which is kind of slowly continuing this move to the downside, or at least that's what we saw yesterday. Price is still in this kind of very key area of liquidity, however, so we could definitely still find some bullish momentum to push price once again to the upside from this area, depending on data that we do get this week. But today, just keep your eyes on whether price does react to this level at some point, or if in fact we do break below, we could definitely be looking at a break and then a hook back and then continuation to the downside, because this level down here is a very key level to kind of mark out the range where price has currently been kind of acting within. So if price does break below this area, we've got a lot of bearish kind of momentum that's likely going to enter the market. So keep your eyes on that. Next talk about though is Bitcoin, which hasn't seen too much momentum since we did break those all-time highs most recently. That said though, yesterday we did see price break above the $70,000 a Bitcoin mark, and now price is halted just above that $70,000 a Bitcoin mark at 72,000, which is just crazy to kind of see and note, because of course we've just seen so much volatility over the past few months for Bitcoin, so much news come out in relation to Bitcoin, and now prices making new highs every single day, which is just crazy to see. So if price can make its way up to this minus 27.2 though, we could definitely see a bit of a sell-off from that area, as those buys are kind of then exhausted. So keep your eyes on Bitcoin. Next to talk about though is gold, which as a result of the US inflation rate figure that we're getting today, it's likely that we'll see a great deal of movement on gold, as it does act as this kind of safe haven asset against inflation in the US. So definitely keep your eyes on gold, which is currently sitting at all-time highs, and yesterday last week did break all-time highs once again, and even near that kind of $2,200 an ounce level. So crazy levels for gold. Next to talk about though is oil. Lastly to talk about in the charts is oil, which is just continuing to range. We've seen price just range since the start of February now on oil, and it just seems like it's never going to end. But obviously tensions in the Middle East will be greatly affecting oil, so keep your eyes on all of that. That's all to talk about in the charts though. Lastly to talk about, of course, is the economic calendar, where we're getting a great deal of data today. Now firstly, we are getting the German inflation rate figure, followed by some British unemployment rate data, and more specifically the British unemployment rate figure, which will be very important to listen out for in regards to pound yen and that kind of thing. Followed by that, we're hearing about some new Chinese yuan loans, And followed by that, we're then getting the US inflation rate figure, which is the most important piece of data for the day. So make sure you hear that. We're forecasting 3.7% inflation for the core inflation rate figure for the US, and 3.1% with no change on the the basic inflation rate figure for the US. So definitely look out for that piece of data. And finally, we're getting the US monthly budget statement. So that's all to kind of talk about on the economic calendar, though. We've got lots on the articles, lots on the charts, and lots on the economic calendar. Once again, I'm sorry for the sniffling. I'm sorry for being ill. But I hope you have a great trading day. That's all from us at Wildwood Capital. Have a great one. See you later. Bye.